Dear students, measurement of national income is an important area in the chapter National Income Accounting. As you all know, there are three methods to measure national income: the income method, the expenditure method, and the value added method. The value added method, which is also known as the product method, first identifies GDP-MP, later converts GDP-MP into NDP-FC and NNP-FC. Expenditure method also follows the same protocol. First, GDP-MP is identified, thereafter converts GDP-MP into domestic income and then national income. While the income method initially arrives at the domestic income, that is the NDP-FC, thereafter converts the NDP-FC into NNP-FC, which is the national income. Let us look at each method in detail and demonstration of finding national income using these three methods. First, let us discuss the value added method, which is also known as the product method. What is value added? Value added is the addition of value to the raw material by a firm by virtue of its productive activities. The value added is the difference between the value of output and the value of intermediate consumption. Value added, GVMP, is equal to value of output minus intermediate consumption. In the absence of value of output, we have to make use of sales and change in stock to get value of output. Hence, GVMP is equal to sales plus change in stock minus intermediate consumption. You know that change in stock is the difference between closing stock and opening stock. What are the steps in computing national income using value added method? The first step is to identify and classify the producing units of an economy into primary, secondary, and tertiary sectors. The second step aims at estimating GDP-MP. GDP-MP is the sum of the gross value added at market price of all the three sectors. GDP-MP is equal to sigma GVA-MP, that is, the GVMP of primary sector plus GVMP of secondary sector plus GVMP of tertiary sector. After computing GDP-MP, the next step is to arrive at domestic income, that is NDP-FC. NDP-FC is equal to GDP-MP minus consumption of fixed capital minus net indirect tax. The last step is to estimate the net factor income from abroad and add that to the domestic income to get the national income. National income NNP-FC is equal to NDP-FC plus net factor income from abroad. Let us have an illustration of how the value added method is employed. Here in this example, you have producing enterprises in an economy. There are 4 producing enterprises: farm, flour mill, baker, and shopkeeper. Given is the value of output received by each enterprise and their cost of intermediate goods. The aim is to find out the value added in that economy, that is GVMP. As you know, GVMP or value added is the difference between value of output and intermediate consumption. See, for example, farm. There the value of output is 600 rupees and the cost of intermediate good is 200. The total value added here in this farm is 600 minus 200, that is 400. Similarly, you can find the value added in all the other sectors. The GVMP here is the sum of the value added in all the 4 sectors given. Here GVMP is value of output minus intermediate cost, which is 3,600 minus 2,600. The total value added is 1,000. This is how value added is found out in an economy. Now, how to compute GVMP and national income? This is shown in the illustration given here. Here you can see that the value of output of primary, secondary and tertiary sectors are given separately. Also, the value of intermediate consumption by each sectors are given. Along with that, the indirect tax paid by all sectors taken together, the depreciation of all sectors together, the factor income from the rest of the world, the factor income paid to non-residents, and subsidies received by all the sectors are given. The first task is to find out GVAMP, that is the value added. Again, apply the formula. GVAMP is equal to value of output minus intermediate consumption. Here, 3 sectors are given and the value of output and intermediate consumption of 3 sectors are given separately. So you have to find the aggregate of value of output of all the 3 sectors and the aggregate of intermediate consumption of all the 3 sectors. So here the formula need to be modified as value of output is a sum of the value of output of primary sector plus value of output of secondary sector plus value of output of tertiary sector minus intermediate consumption of primary sector plus secondary sector plus tertiary sector. Here it is given as 800 plus 200 plus 300, that is 1300 is the total value added of value of output of the economy minus 550 is the total intermediate consumption of all the 3 sectors. So the GVAMP here is rupees 750 lakhs. And this GVAMP is the GDP MP of the economy. The second part of the question needs to find out the national income, which is NNP-FC. When GDP MP is given, to find NNP-FC, you have to subtract depreciation and net indirect tax, and you have to add the net factor income from abroad. So GDP MP minus depreciation minus indirect tax minus subsidies plus factor income from rest of the world minus factor income paid to non-resident. By applying the given values and substituting them, you will get the national income as rupees 630 lakh. Another illustration is provided here for your practice. This question wants to find out net value added at factor cost and national income. Please note that we are not asked to find out GVAMP, instead NVAFC. So first we have to convert GVAMP into NVAFC. The items given here are the purchase of machinery to be used in the production unit 100 crores, sales 200 crores, intermediate cost 90 crores, indirect taxes 12 crores, change in stock 10 crores, excise duty 6 crores, stock of raw materials 5 crores, and net factor income from abroad minus 10 crores. In order to find NVAFC, you have to subtract depreciation and net indirect taxes from GVAMP. And you know GVAMP is obtained by adding sales and change in stock, and from that subtracting the intermediate cost. By applying the given values, you will get GVAMP as rupees 120 crores. Now to find NVAFC, GVAMP minus depreciation minus net indirect tax. As in this question, the depreciation is not given, you have to assume the depreciation or the consumption of fixed capital as 0. Instead of net indirect taxes, indirect tax and subsidies are given separately. So NVAFC is equal to 120 minus 0 minus 12, which is rupees 108 crores. After finding NVAFC, you have to find national income, that is NNPFC. Either you can directly convert NVAFC to national income, or you may convert GVAMP into national income. NVAFC is similar to NDPFC, which is domestic income. So NNPFC national income is equal to NVAFC plus net factor income from abroad, that is 108 plus minus 10. And the value of national income will be rupees 98 crores. Also note that in this question, subsidies are also not given. So for those items which are not given, you have to assume it as 0. The second method to compute national income is the expenditure method. In this method, national income is estimated by taking the sum of all final expenditure incurred by the economy from different sectors, namely households, firms, government and rest of the world. Here in this method, the GDP-MP is obtained by taking the sum of all the final expenditures incurred, that is C plus I plus G plus X minus M. You know, C is apart from the household, which is given as private final consumption expenditure. I is made by firms, which is gross domestic capital formation. It includes all the investments made by the firms, government and the household. If gross domestic capital formation is not directly given in the question, make use of gross fixed capital formation and change in stock to arrive at gross domestic capital formation. Gross domestic capital formation is the sum of gross fixed capital formation and change in stock. In the absence of gross domestic capital formation, if net domestic capital formation is given, add depreciation to make it gross. G represents the government sector, and there the government final consumption expenditure is included. And the last one is the rest of the world, where the difference between exports and imports, that is net exports. This is used to find out national income using expenditure method. How to find out national income using expenditure method? Let us see that step by step. In the first step, identify the final expenditure incurred in an economy, which are incurred by the household, firms, government and the rest of the world. So you have to classify the expenditure made by these sectors as private final consumption expenditure, government final consumption expenditure, gross domestic capital formation and net exports. The second step is to compute GDP-MP. GDP-MP is private final consumption expenditure plus government final consumption expenditure plus gross domestic capital formation plus net exports. Once GDP-MP is computed, you may compute domestic income NDP-FC. NDP-FC is equal to GDP-MP minus depreciation minus net indirect tax. As a last step, estimate net factor income from abroad and add that to domestic income to get national income. NNPFC is equal to NDPFC plus net factor income from abroad. Let us discuss how to compute GDP-MP and national income using expenditure method. In this illustration, gross investment is given as 90 crores, net exports is given as 10 crores, net indirect tax is given as 5 crores, depreciation 15, net factor income from abroad minus 5, private final consumption expenditure 350, and government purchases of goods and service 100. To find GDP-MP, add the private final consumption expenditure, the gross investment. The gross domestic capital formation is here given as gross investment by all sectors, and then government final consumption expenditure is given as government purchase of goods and service, and net exports is given directly. Add these four components to get GDP-MP, which is rupees 550 crores. To find national income, that is NNPFC, GDP-MP minus depreciation minus net indirect tax plus the net factor income from abroad. All these items are directly given in the question, so substitute them and you will get national income as rupees 525 crores. To improve your confidence, one more question is given here. Calculate NDP-MP and national income. Private final consumption expenditure is given as 400, opening stock 10, consumption of fixed capital or depreciation 25, imports 15, government final consumption expenditure 90, net current transfers to the rest of the world 5, gross domestic capital formation 80, closing stock 20, exports 10, net factor income to abroad minus 5. Please note that here instead of gross domestic capital formation, gross fixed capital formation is given. So you have to add change in stock to gross domestic fixed capital formation to compute gross domestic capital formation. Here, change in stock is not given directly. Subtract closing stock and opening stock to get change in stock. Instead of net exports, exports and imports are given separately. Subtract imports from exports to get net exports. To compute GDP-MP, first add private final consumption expenditure, government final consumption expenditure, gross domestic fixed capital formation, plus closing stock minus opening stock, plus export minus imports. The GDP-MP is 575 crores. But the question requires you to find NDP-MP. So the task lies in converting GDP-MP into NDP-MP. NDP-MP is equal to GDP-MP minus depreciation. All other aggregates remains the same, only gross need to be converted into net. So it is 575 crores minus 25 and the value is rupees 550 crores. NDP-MP is rupees 550 crores. NNPFC can be found either from GDP-MP or from NDP-MP. Here I have employed GDP-MP minus depreciation minus net indirect tax minus net factor income from abroad. But instead of net factor income from abroad, here net factor income to abroad is given. Hence, instead of adding net factor income from abroad, subtract net factor income to abroad. So national income is equal to 575 minus 25 minus 0 minus minus 5. Here the 0 is for the NIT, net indirect tax, because here the net indirect tax is not given. So NNPFC is equal to rupees 555 crores. The third method to find national income is the income method. It is also known as the factor payment method, as we take the factor payments received within the domestic territory to find national income. This method is the most easiest and understandable method among all the three methods. In this method, all the factor income received by the factors of production by way of wages, profit, rent, and interest are summed up to estimate national income. The major components of this method are compensation of employees, which is composed of wages and salaries in cash, wages and salaries in kind, and employers' contribution to social security schemes. Pension on retirement is also included or a part of compensation of employees. The second major component is the operating surplus, which includes rent, interest, profit, and royalty. Profit is composed of dividend, corporate tax, and net retained earnings, or the savings of private sector. Last is the mixed income of self-employed. So these are the major components of income method. Let us see the steps in computing national income using income method. The first step is to identify the domestic factor income in an economy, that is, the compensation of employees, operating surplus, and the mixed income of self-employed. To find the domestic factor income, add compensation of employees, operating surplus, and mixed income of self-employed. This will give you the domestic income, that is the NDP-FC. To compute national income, add net factor income from abroad to the domestic income. This can be explained with the help of an illustration given here to find national income. The compensation of employees is given as 2,000, profit 800, rent 300, interest 25, mixed income of self-employed 7,000, net current transfers to abroad 200, net exports minus 100, net indirect tax 1,500, net factor income to abroad 60, and consumption of fixed capital, that is depreciation 120. Please note that there will be certain values and items given in the question which are not required in this method. Kindly ignore such unnecessary items. Go with the items which are required as per the particular method. If any of the values that are required are not given, ignore or put 0 for those items and continue with the given items. Let us see in this method how to compute national income. First, it is advised to find domestic income by adding compensation of employees, rent, interest, profit, and mixed income of self-employed. Rent interest, profit, and royalty are taken separately if operating surplus is not directly given in the question. Also note that in the absence of profit, dividend, corporate tax, savings of private sector are to be incorporated to get the profit. However, in this question, all the items are directly given and hence NDPFC is equal to 2000 plus 800 plus 300 plus 250 plus 7000, which is rupees 10,350 crores. Once the domestic income is arrived, add net factor income from abroad to get national income. However, here in the question, instead of net factor income from abroad, net factor income to abroad is given. Then you have to apply the reverse operation, that is, instead of addition, you have to subtract it from the domestic income. So NNPFC is equal to NDPFC minus net factor income to abroad, and national income is rupees 10,290 crores. Let us discuss another illustration too. Items given are profit 1000 crores, mixed income of self-employed 15,000, dividend 200, interest 400, compensation of employees 7,000, net factor income to abroad 100, depreciation or consumption of fixed capital 400, net exports minus 200, net indirect tax 800, net current transfers to rest of the world 40, and rent 500. Here in this question, net current transfers to the rest of the world being a transfer income is not required. Kindly ignore it. How to find national income here? Please note that operating surplus is not given directly. Rather, components like interest, rent, profit is given. Here profit and dividend both are given. In such cases, understand that dividend is already included or a part of profit. Hence, if profit is not given, ignore dividend, which is also given in the question. To compute national income, first find the domestic income. This can be obtained by adding the compensation of employees, rent, interest, profit, and mixed income of self-employed. By substituting the given values, you will get domestic income as rupees 23,900 crores. Here, the net factor income to abroad is given. Hence, you have to subtract net factor income to abroad from domestic income to get the national income. Here, the national income is rupees 23,800 crores. Dear students, I hope you have understood all the illustrations and the steps as explained in this video. Merely listening these videos will not help you in becoming a pro in national income accounting. For that, efforts from your part in answering the questions yourself is required. Do practice as many as number of questions from the question banks given by your teacher. Hope practice makes you a perfect learner in national income accounting. Wish you all the best.